So the payout policy, a company can pay to its shareholders in two ways, either by paying a dividend from the profit, or can pay to the shareholder in the form of share repurchases, that is, buy back the shares from the market. Okay, that's called share repurchase. The surplus cash still distributed, is still paid out. It leaves the company. It will, be in the hands of the willing shareholders who sell their shares to the company in the case of a share repurchase. In the case of dividends, everybody, all the shareholders get their share from the earnings in the form of cash dividends. So comparing cash dividends to the stock repurchases. Dividends are, if they are paid to the shareholders, there are a number of things that we can observe that the companies do from research, from asking the company managers how they go about their payments of dividends. We find out that dividends are rarely cut back once they announce a payment of $1 dividend, for example. Then in the future, the management tries to pay at least the $1. So they don't like to cut back because there are this information content of the dividend. Information content, that is, if company cuts the dividend in the future, that sends a bad signal to the market that the company somehow is not managing to pay dividend that were used to pay, that they were used to paying. So that is the signal to the market, and that signal, which is a bad signal. Why? Because that affects the share price. The share price might be affected by this information. Managers do not increase dividends unless confident that dividends can be maintained. So this is related. That means they only increase the dividend if they are sure that in the future after that they will not be having to cut back again because of that reason. That is the signaling, dividend signaling, or as it is also said, this information. Let me write that down. Information content of dividends. Okay, that is the $1 itself is not very important, but if it falls, if it falls to, let's say, $1 becomes 0.80 cents in the next year, right? That is a fall from $1 to 80 cents. That sends a bad signal that people will think, the shareholders, that company is somehow having trouble, because this comes from the asymmetry of information between the shareholders and the company, shareholders and the management. The shareholders know less than the company managers, so they rely on this type of information, like hints that is contained in these actions of the corporation, because they know that the management will not tell all the information, will not share all the information that is going on with what's going on with the company. Okay, so they only share the good news, they think, because that's usually it's also the truth. The management does not like to share bad news because they are also afraid of that affecting to the share prices. So the shareholders will get their news from this actions. So it's like there is a saying, yeah, which says actions speak louder than the words. So this is what you can apply it here that's applicable here. Okay, in the case of stock repurchases, the company is more flexible. Yes, that is that means the company can decide when to repurchase. So once they do a repurchase in one of the years, and they don't have to do the same in the next year, because the repurchase does not have that kind of information content like dividends. Okay, so that makes the company flexible in carrying out a repurchase program. The thing about the tax advantage of repurchases is there is this we're going to discuss further. When the company repurchases the shares, the shareholders will pay the tax on the capital gains that they made. Okay, that is, if they buy at a lower price and sell at a higher price, they're going to pay for the difference, which is called the capital gains. They're going to be taxed on that, which is income to them. In the case of a dividend, they pay, income tax, which is on the dividend income. And there is a difference between these tax rates. In the past, the taxes on the capital gains were lower than the tax on the dividend income. Therefore, used to be that the repurchase were tax advantaged. That is, a company, will transfer more wealth. That is, the shareholders will save in the case of repurchases by paying lower taxes. Okay, so historically, looking into how the companies paid to their shareholders, starting from 1980s, how many years? 30 years information. The composition of overall payments, you can see that repurchase became more and more popular in the overall payment to the shareholders. Nowadays, see, it's like not nowadays, but is the last information here in 2010. You see that it's almost 50-50 split between dividends and share repurchases. Yeah, are you seeing what I'm seeing? I hope. Yes. Because I can see there is a two slides open there. Let me check. Yes, two. Yes, okay. Okay, so I think you see the same thing as I see. Okay, so that shows the rise in the popularity of repurchases by firms. Now let's talk about some facts about dividend payments. Starting with dividends, then we'll move on to the repurchases. There are a number of days which are called important days for dividend payment. These are the ex-dividend date, record date, and then there are a couple of more days, declaration date, and payment date. There are 4 dates. So some of them are listed here. Ex-dividend date is date which determines when stockholders is entitled to dividend payment. Okay, yeah, let's see that in this example. Here, this illustrates what these dates are. So let's say ExxonMobil on January 5 decides to pay 42 cents per share dividend, which is a quarterly dividend. That means every quarter they normally pay dividends. So this quarterly dividend they announced to be 42 cents per share. And they did that announcement. The CEO came out and announced this dividend on January 5th. And on the same date, the manager announces the further dates. Sure. He or she says that for this announcement, the ex-dividend date will be February 8th. So like about 1 month later, yeah? He's gonna say here that ex-dividend date will be February 8th. And he says the other dates. The record date will be February 10. And he said the payment date will be March 9. So from this, you understand, this one is straightforward, that the actual payment will happen on the March 9. Okay, that is a check. Check will be mailed to the shareholders. What are these two dates? Okay, so let's tackle this. The February 10, which is the record date, means the company will make records of the people who have the shares so that they know whom to send the check. Okay, who will get the dividend. They make a record on the February 10. Then what is this February 8? You may ask. February 8 is a date, at which, from the morning of February 8, whoever buys the stock is not entitled to this dividend. Okay, if you buy the stock of ExxonMobil on February 8, that you should know that you will not get this dividend. That's what ex-dividend date means. If you buy the stock or hold the stock right now, or buy the stock before the February 8, which is February 7 and so on, yeah, then you are entitled for this 42 cents dividend. So why this date is important? Why there is this? Why didn't they, for example, set the date the same? Yeah, like record date is X dividend. Like they make a record. So whoever has the dividend now will get. I mean, the share now will get the dividend. After that, they don't get. Yeah. So, the reason for setting these two dates is that historically there was a delay in the information about the share ownership, which is transferred from the brokerage houses to the company. So they're allowing 2 days for the information transfer. Okay, so all of these payments, this ownership rights will be settled within these 2 days. So the company now knows, who is the holder of the shares, until February 8. Okay, on this date, so they know who will be getting the dividend. So February 9 here is the date they allow. If you buy the shares on this, you're still not getting the dividend, even though the record is made on the February 10. Any questions on this point? Because usually there is a confusion in these dates. Okay, I hope this is clear for everybody. So what else? So see, the dividend payment does not occur immediately. There is these dates which are set so that everything is in order. The company knows who is the owner, because there's millions of shares in the hands of shareholders. That's why this is this needs to be done. These dates should be allowed for the payment of dividends to who is the rightful owner of the shares at the time of this announcement and until the ex-dividend date. So I would say that. So, so record date is a person who owns the stock on this date receives the dividend. Who owns the stock on this date receives the dividend. Well, this is not so correct, because if you bought on that day, you're not getting the dividend. It's the ex-dividend date, which determines when stockholder is entitled to dividend payment. Okay, and one more thing happens. You'll see that why is it important? Okay, is that the stock price will react to the price. Oops, did I press a poll something? Yeah, sorry. If the stock was trading at certain level, or like a small graph about like what the stock price, the behavior is going to be. So these are the you know, time, yeah, the days or time. This is time, and this is like the value of a share. So let's say for ExxonMobil, no news is happening. Everything is as expected. No other news is happening about ExxonMobil. The things are usual. That means the stock will trade, let's say, at this level. Let's say it's, I don't know what the price for Exxon at that date was. Let's say $100. Okay. And the dates here is the before January 5. Okay, and what happens is that until February 8, the stock will trade at this $100 level. Here is February 8. Okay, February 8. So what happened on the February 8 is that because on the people who are buying the shares on February 8 and after that, they are not getting the dividend, the stock price will reflect that proposition. The stock price will fall, will drop by the amount of dividend approximately. It will fall by the amount of dividend. Okay, this is not very to the scale, but let's say this is fall is 42 cents. Okay, so it's gonna trade at $99 and about how much 78 cents level after that. Okay, so this, see, this is it's fair. The market will reconsider, market will revalue the shares of ExxonMobil because of this announcement that those people who are buying the shares on February 8 will pay $99.78 for these shares. Those people who are buying the shares before the February 8, that is until February 8, last day is like February 7, it will trade at a $100 price. Okay, so that's why these dates are important for the shareholders to know when the value will change because of the dividend. Okay. Other things about dividend payments. The dividends can be in the form of stock dividend also, which is a distribution of additional shares to firm stockholders. This usually happens if the company does have a problem with cash, but still wants to pay dividends. They may pay it in the form of stock dividends by issuing additional shares to the existing shareholders. It's called stock dividend. Stock split. Okay, we're not discussing it here, but it's additional issue of shares to the firm's stockholders. That is not the same as stock dividend. This is exchange of existing shares to a new number of shares. That's stock split. Okay, can be in the different proportions: 2-for-1, 3-for-1, 2-for-3, 3-for-2, in these different proportions. It can be done. So share repurchase, you understand. Types of dividends. Dividends themselves can be of different kinds. Yeah, like it's a regular dividend, your cash dividend, regularly paid in the cash. And the cash dividend itself is also two forms: regular cash dividend and special cash dividend. So regular cash dividend means what the company has a history of paying. Okay, it may be like $1. It may be like in this example of ExxonMobil, 42 cents quarterly, 42 cents quarterly, yeah. And next quarter is 43 cents. Then another 43, 44. Okay, it continues like that. This is like a example of a regular cash dividend by Exxon for the year, paying these dividends. See, I intentionally made the dividends increase a little bit, but not fall. That's how normally the dividends are paid, because like we mentioned, this information content of the dividends. Special cash dividend is, like the name suggests, it's a one-of-a-kind event, which does not occur every time. It doesn't occur regularly, but it's a special occasion. So what's the reason? For if Exxon pays like a $4 dividend, $4, that doesn't look like these dividends. And actually, when they do pay this $4, they will announce that this is a special dividend. They're gonna tag this as a special dividend, and they will say these are the regular dividends. And from the history of payments, you can see that these are regular payments. They will be more or less close, and then maybe increase a little bit, sometimes decrease, but rarely they decrease. So this special cash dividend is paid when in the case that the company does not have good investment opportunities for the cash. It has a surplus of cash and wants to pay to the shareholders, but does not wish to continue doing that in the future. Then they call it special dividend. The repurchase themselves can take a number of forms, methods: buy shares in the regular market, make a tender offer to the shareholders through the Dutch auction, or private negotiation. Okay, I didn't see this in the books, but this is mentioned. Okay, not important for our purposes right now. Yıldız, yeah, can you explain the special dividend one more time? Okay, I can give you like history of this actual situation which happened with Apple about the special dividend. In 2001, if I believe it's correct, in 2001, was it Apple? No, it was Microsoft. Microsoft paid a special dividend, total $32 billion. $32 billion was paid by Microsoft, but that, was not something that they used to do. Okay, why they did it? Because the Microsoft at that time was a cash cow that has a lot of cash, but they didn't have much, projects to invest this cash. So even though Microsoft did not pay in the past, now they had to pay it, because there is this, situation with investment in the corporations. If the company cannot earn for the shareholders the rate that is the required rate of return, then they should pay to the shareholders. So Microsoft had to that kind of situation that they could not earn the opportunity cost of capital. The shareholders could earn a higher rate at other investments. So therefore, Microsoft paid this special dividend. They announced that this is a special dividend. So why they call it special dividend? Because again, of the information content of the dividend, so that the shareholders do not expect in the future that this will return. Okay, this will continue. That's why it's called special dividend. Okay. Yes, that was the largest distribution in corporate history. Very, you know, you can get this. Actually, it's in the book. It mentions, and Apple also did that special dividend. So. Yes, in some cases they will pay, yeah. Special cases, special occasion. You know, like you know, think about, you want to buy your friends regular, or let's say not friends, but what you do, like for example, parents bring to their kids regularly. They buy, for example, every week some snack or some, you know, cake, something. But for a special occasion, they say this is a special, you know, occasion. That's why they buy like a large, you know, treat, and they say this is not a regular, you know, so that kids do not expect and then nag the parents to buy this every time. Okay, so something like that. Okay, now there's a survey, you know, described about companies, how they pay their dividends. In 2004, they asked the managers, top management answered to this survey like this, that they try to avoid reducing the dividend. See this, almost all of the corporate managers try to avoid reducing the dividend, which is that regular dividend. They try to maintain smooth dividend stream. So like in this example I gave, see, this is like a smooth dividend stream, increasing a little bit, but it's very smooth. Why? Because they do not want to ripple that expectation because of information content that dividend brings. We look at the current dividend level, not the particular amount, but the level. We're reluctant to change that may have to be reversed. Yeah, they do not want to cut back dividends. So a lot of them say 78% they said that. We consider the change in the dividend. Okay, what this means is that not the amount of change, but the change is important. Like increasing the dividend slightly is good, rather than the actual amount. Rather than reducing dividends, we would raise new funds to undertake a profitable project. Yeah, when it comes a situation that they do not have cash to pay the dividend at the level of they were paying before, what they do is they rather borrow money in order to undertake some projects, but they will keep the cash to pay the dividends that they used to pay. The cost of external capital is lower than the cost of a dividend cut. Yeah, they believe that, half of them believe that raising additional capital is going to be cheaper than cutting the dividend. So all of this stresses that dividend cutting is not something that managers like, because you know, most likely that they felt the effect that this brings to the share prices because of all of this we said information content of the dividends. Well, next. Okay. Information content of dividends and repurchases. Payout decision. Managers are reluctant to make dividend changes that may be reversed. Yeah, we mentioned that. Managers worry about resigning dividend increase and raising new funds to maintain payout. Okay, payout decision. All right, payout decision. Here is an example. Managers focus on dividend changes over absolute levels. Let's say paying a dividend of $2 per share is important if last year dividend was $1.50. See, there is an increase. Like, you know, this is something like this. $2 dividend now is good news if last year dividend was $1.50. See that? That is it's increase, okay? But $2 dividend is not good news if last year dividend also was $2. It's nothing new, okay? It's not nothing new here. that we find out. Last year, okay, it's like shareholders telling like this, tell me something new, right? Tell me something new that I don't know, okay? So $2, they already knew the company paid last year, so $2 paying right now doesn't give a good, something new, something extra that we do not already know, okay? So that is the point here. The information content of dividend stock reports decisions contain information. Dividend stock reports. See, this is something that doesn't make sense. Dividend decision contain information. Information contained in decisions will be various because of asymmetric information that may be conveyed. Dividend increase could mean overpriced stock or increase future profits. If the company is increasing its dividend, it may mean also that the stock is overpriced or increased future profits. So more likely the market will take that increase in dividends, that things are good about the company. That's why they're increasing, because the shareholders also know that the companies are reluctant to cutting the dividends because of that information content. So increase in the dividends signals that the future profits is going to be increasing. Signal varies based on prior information about the company. Okay. So some of this put into like a formula form. Dividend, which is expected, that is a target dividend, can be calculated as a target payout ratio times the earnings per share in year one. Target payout ratio multiplied to the earnings expected in year one. And the dividend change is the difference between dividend 0 and dividend 1, right? That is the current dividend and the future dividend. That gives you the target change. So by substituting the formulas here, you can find out that target ratio minus EPS 1, which is this one, minus the dividend 0. That way you can find out like our expected dividend change. Okay, all right, I'm gonna skip that. So now let's talk about this in the form of a rational semiconductor company who is, has a $1 million extra cash. So this company has $1 million extra cash. You see the market value balance sheet of a rational semiconductor balance sheet. The thing in this book is this company names are very interesting. There is no such thing as semiconductor. There is semiconductor, right? There is not semiconductor, but they made it like made up company. So they have $1 million cash in the assets, and the rest of the assets worth $10 million overall, $11 million asset side, and which is on the right hand side is balanced by equity, no debt. This company is all equity company, no debt. So so if assets is worth 11 million, the equity is also should be worth $11 million. And if the company has a $1 million on issue, right? $1 million on issue that is in the hands, that means the share is going to be $11 per share in the market. So $11, the market share price is $11. So that's $11 million. And now, what if the company pays out this cash to shareholders in the form of dividends? So I want to see that both. First, what happens to the balance sheet, to the share price, if the company pays this cash in the form of dividends? So that, how much dividend can they pay with $1 million? 1 million divided by 1 million shares, yeah? All of this $1 million should be paid. It will be $1 per share. Dividend will be dividend per share will be $1 million divided by 1 million shares, yeah? That's $1 per share. So after that is done, what happens to the share price? It's gonna be like this, see? Because the cash is paid, now the company has no cash, yeah? It's paid in the form of dividends, so no cash. The assets are still worth the same. And here we are not doing anything else, other things are equal, okay? The company is not doing anything else. That's why the value of fixed assets, investments, and all of that is worth the same as before. And how we balance that? That is by, valuing the equity now as a $10 million because assets is worth $10 million because it's equal, yeah? So then you can now find out the new price. Now $10 million equity. How many shares? It's 1 million shares. And you get the value of equity, like the price of equity. It's gonna be $10 per share. See the fall in the price is $1. It was $11 here, $11. Now it's $10. So that's what happens if the company pays the surplus cash in the form of dividends. The share price will fall by the exact same amount of dividend. So now what the shareholders have, the shareholders' wealth is like this, like the individual shareholder who owns like one share, now owns share worth $10 plus $1 in cash. $1 in cash. That's still $11 as before. So $10 worth of shares, yeah? And $1 in the form of cash. Total $11. Before this, that same shareholder had the $11 worth of shares, no cash. So is it good? Is it bad? So now we're gonna see in this discussion. How about the repurchases? When we are doing repurchases, this had some ways to value the shares. Okay, here's the same example. I think this time, yeah, this is what I just showed you in the calculation. What is different here? Yes, the same thing with more details. Yes, where this 10 million coming from? Yeah, it is 1 million shares at valued at $10 each. Okay, that is in year 0. Okay, so this is like just continuation of that with more details. The controversy about paying this in the form of dividend or repurchases. And let me see. I was expecting something else here. I want to show you that. The repurchase is not shown in the slides. It's given in the book. So let's now discuss what if the company, instead of paying this in the form of dividend, decides to repurchase its shares. Okay, so that's the question. So if they decide to spend this $1 million surplus in order to buy some of its shares, it will buy its shares at the price of $11, which is here. Okay, let me try the calculation here. Let me erase this so to make room, and I'm gonna write up that situation with the repurchase. So they have $1 million and they want to buy the shares. they're going to buy them at $11 market price. If you divide that, 1 million by 11. That gives 90,000. Okay, I'm gonna you guys. So some of our students, and willingly probably. No, this is not a special dividend. Let's. Yeah, this may be a special dividend, the case of a special dividend too, but here it's not so important. Okay, let's say the effect of the, we're looking into the effect of the dividend and share repurchase to the value of the shareholders, to the wealth of the shareholders. Okay, so what happens is that now the shares in the hands will be this much less. That means 1 million minus this. Okay, 1 million shares. How much is that? 90,909. And that is 909,091 shares. Now the company shares in the hands is this much. Yes. Special, you can call it special dividend. Okay, so now what will be the value of these shares? Yeah, I mean the company after this payment. So bear this in mind. Yeah, you saw this, that when the company pays the surplus cash, what happens? This becomes zero. Yeah, became zero. They paid, and this is now 10, and this is also 10. Yeah, it's also 10. So this also should be 10. But this $10 million valued equity is represented now not with the 1 million shares after repurchase. It's represented by this many shares. Yeah, this many shares. So now we can find out the market price of a share, you know, like this. To get a 10 million, how many? At what price should be these shares? That's the question here. Yeah, they will. Yeah, to find out, what you do is you divide $10 million this by this number of shares, 90. I cannot write it here because of these controls. 90,091. Yeah, this number. So you divide, what do you get? 10 million divided by that. Okay, see, if you do that, you'll see that surprisingly, or as expected, $11. Oops, it's going to be $11. What does that mean? You know, what does it mean? It's a very important conclusion we can make from this. That if instead of paying dividends, the company decides to repurchase its shares, the same cash, yeah, because company is free to do that. The share price remains stable. The share price, see, it's stable. It's $11. If instead the company paid out the money as dividends, the share price fell. Share price fell to $10 per share. This $10 per share. Okay. in the case of a share repurchase, share price is stable. Did you get this point from this calculation? Is it clear? Great. So that is that what happens with the repurchase. It keeps the share price stable, and that is one of the arguments why the share repurchases became more and more popular. Like you saw in this chart over the years, the repurchase becoming very popular. See, was not so popular in the past. Was a small part of overall payment, but now see it's almost half of the payments are paid in the form of repurchase. Because of that flexibility, it doesn't affect the share price, does not have information content, which worries the managers. You know, they do not want to what you call disturb the market. So that's can be achieved with the share repurchases. Okay, now we move on with discussing about what this, in this point here is something interesting. What if the company decides to pay out 1/3 of its value as dividends? Okay, 1/3 of its value as dividends. Then what happens is that the overall company value will stay the same because company is not doing anything else. So what happens is that all the shareholders will lose value. Okay, they will lose value by that exact 1/3 amount. So here is like 6 boxes, and then there's 2 boxes. The company, in order to do that, they are issuing new shares. Okay, so it will be the company will be issuing new shares in order to pay dividend to the old shareholders. So if before each share was worth this much, then it will fall to this much. It will be smaller like this. This is like the fall is by 1/3 of the value as it was before. So after this issue of shares, the company overall value same, but the old stockholders now have a stock which is worth less but have cash. So this is, to illustrate that the company is not giving anything extra by issuing new shares in order to pay dividends. So that point is illustrated here. Okay, so the dividend policy of a company can be, like this. That is, issue shares to new stockholders and pay this cash to the old stockholders. But instead, it's the same thing if the old stockholders just exchanged their shares for cash with the new stockholders in the market. So that means the stockholders actually do not need the company to pay the dividend in order to exchange their shares for cash. They can do it themselves in the market by selling some of their shares in the market and getting the cash, and that cash is like dividend. Okay, the shareholders do not need the firm to do that. Okay, they do not need the firm to exchange their shares for cash, because their shares, when they issue shares in order to pay cash for the old stockholders, the stockholders value of shares is decreasing. Yeah, it's decreasing, but some part of it is becoming cash, so they do not need to do that. Okay, now we go into this discussion of Miller and Modigliani theory about the dividend policy. Okay, so let's see. It doesn't mention here, but this starts around this point. Economists, a long time they discussed about the effect of dividend payment to the value of a company. And there came three opinions. One opinion was by Miller and Modigliani, which said the dividend policy is irrelevant. Dividend policy is irrelevant. That means the shareholders do not need the company to exchange their cash, share their shares for the cash, like this suggests. Okay, this diagram suggests. So Miller Modigliani said, let me mention their name here so you remember. Miller and Modigliani. Their proposition is called dividend irrelevance. Dividend irrelevance proposition. So those earlier calculations I presented also suggests this view of Miller Modigliani that company not paying dividend was keeping the share price stable, like $11, but after the payment it's still overall the same, just with the $10 worth of share and $1 cash. So that is there. And in order to come to this conclusion, Miller Modigliani kept a number of things stable. That is perfect markets, no taxes. What else? No transaction costs. So in this kind of world, the dividend policy does not affect the value of a company. So it's irrelevant. Okay, so their assumption was like that. Investors do not need to convert shares to cash. They will not pay higher prices for firms with higher dividend payouts. Dividend policy will have no impact on the value of the firm. That is their conclusion. But there were another group called, actually two groups, rightists and leftists. So actually we can talk like this, make the three camps. This camp, the middle one, and so this is like a left, yeah. This is right. This is center. This is center. This is the Miller and Modigliani camp. Miller and Modigliani, who claim that dividend policy is irrelevant. The rightists say, dividend is better. Yeah, rightists say dividend is better than repurchases. Here, Miller Modigliani said it's the same thing, like repurchase or dividends doesn't matter, okay? And there is a left. There is a leftist, like camp. The people here believe repurchases are better. Repurchases are better than dividends. And earlier, in the beginning, I also talked about this, the advantage of repurchase, yeah? Like the repurchase keeps the price stable. Okay, let's now briefly discuss each camp. Miller-Modigliani showed that in the case of efficient markets, no transaction costs, the number of assumptions, the dividend policy does not matter. Now let's see the rightists, what they say. Yeah, they're saying dividend is better than repurchases. Why? Here is this is what this picture I drawn. Middle of the rotors, left is stereo with some realities thrown in. Dividends increase value. Dividends do not affect value. Interesting. These slides are talking different things than what the book says. The book put the Miller-Modigliani in the center. Okay, the rightists believe why that they think that dividend is better. Because there are in reality there are groups of investors who rely on dividends. This can be these students, the pensioners who rely on dividend payments. They're going to value the stock of a company which pays regular dividends more than the company which does not pay dividends. So that's why rightists believe because of this clientele effect, there is clients who value the shares more, which pays dividends. There is an advantage for companies to pay dividends. The argument that we said that you can convert the shares into cash, here has some problems in the case. There's the argument by the leftists, by the rightists is put that this requires some behavioral problems. When you are selling the shares, you need to have a control. You need to know exactly how many shares to sell. If you sell too many shares, that you're going to get rid of all your shares. You will transfer them to cash. Okay, you need to exercise control. If it was paid in the form of dividend, then you don't have that control. It's done by the company, and that is something is valuable for the shareholders. Okay, so that is their argument. So one of their arguments. Another argument that they put about this higher value for the dividend is what was it? They sending good news about the cash flow earnings. Okay, good news. Increase in dividends have a positive effect to the share value, and dividend cuts sending a bad news. So high dividend payout policy will be costly to the firms that do not have cash flows to support it. So it's a signaling effect. So high dividend. Another thing is that, like, also called like bird in the hand argument. We know that company will pay the dividends even if it's not paying right now. It will pay in the future, right? It will pay a large dividend in the future. But if it is paid right now, it's like a bird in the hand. So it's like it gives assurance to the shareholders that they're getting the shares. I mean the dividends. The company is able to pay that, so that's good. And the third thing is also can be mentioned is that companies can succumb to empire building. That is, instead of paying dividends, they can spend this to inefficient, investments, buying up other companies, becoming monopolies, and so on. So in order to prevent this, what is called here, let me mention that empire, this term encompasses all of that, empire building by corporations, if they pay the cash to dividends, they will be prevented from empire building. Okay, so that is also the argument of the writers. Now, before we finish, I know the time is up, let me talk about the leftists. Leftist argument about why opposite is true. That is, repurchases are better than the dividend payments. Here, their argument: capital gains are taxed at a lower rate than dividend income, so companies should pay lowest dividend possible. That's the argument. And historically, that was true. There were two rates, and now also there is two rates that the companies, shareholders are taxed. That is capital gains tax and income tax, which is like a dividend tax. And capital gains tax used to be lower, much lower. Nowadays, still lower, but they're coming close to each other in terms of rates. But if there is still a lower tax in the capital gains, then there is advantage that the company does not pay the payout in the form of dividends, but do it in the form of repurchases. Why? Because then the shareholders will pay the lower tax. There is a tax advantage. So that's the argument. Dividend policy should adjust to changes in tax code. So argument of the leftists. And here is the illustration how the tax is paid. From $100 operating income, the company pays 35% corporate tax, and $65 is paid to the shareholders in the form of dividends. And if the income tax, which is a dividend tax, is 15%, then at the individual level, the shareholders will pay $9.75 from this. This like 15% of 65 is 15%. So what they actually get is $55.25. Okay. But if this was not paid in the form of dividend, but there was like a share repurchase, then they would pay a lower tax on that capital gains that they realize from selling their shares to the company. So they will have a higher value, so they will value the company which does not pay dividend more than the company that pays dividend. Okay, and finally, talking about this graph is the example of Apple's commitment to pay dividends. Historically, see, Apple became so successful that their cash holdings grew in this exponential rate, from about 10 billion or even less, $5 billion in around 2002 to $80 billion in 2011. And this led to Apple to commit to a dividend payment and buyback, which is a repurchase policy, because company having so much cash and does not have this profitable opportunities, then they will have to pay this to their shareholders. Otherwise, shareholders will be unhappy, so they will require the company to pay the dividends. Okay, so this was some things I wanted to talk about. You can find this in chapter 16, this discussion about payout policy. There is no clear-cut, answer here. We are here discussing, the opinions or arguments of these three camps. Each of these have their, what you call valuable argument, valid argument. But this is something that you should be aware, the discussions in the dividend policy. Okay, any questions?